Hello friends. So friends, we are going to continue with the topic of ratio analysis. And in the last lecture, we started with the last set of ratios, that is profitability ratios. Right? So this is the last set of ratios, profitability ratios, and in the last lecture we covered the first profitability ratio, that is gross profit ratio. Right? This ratio tells us that whether we are able to use our various resources efficiently, and with this efficiency whether we are earning sufficient profits. Out of the total revenue from operations, what is the profit that we are earning? Right? Higher the ratio, the better it is. Clear? Now, in this lecture, what we are going to start is, we are going to start with the next ratio, the second ratio, that is operating ratio. Right? So this is the second ratio that we are going to start with. Now, in the operating ratio, first you have to understand one thing, that for any business, if I talk of any business, there are broadly two kind of expenses. One are known as operating expenses, right? The second one, non-operating expenses. Right? If we talk about any business, broadly there are two kind of expenses. The first one is operating expenses and the second one are non-operating expenses. Now, what are operating expenses? Expenses which are incurred directly in relation to the operations of the business. Right? What are operating expenses? Any expenses which are incurred directly in relation to the operations of the business, those expenses are known as operating expenses. Let's take an example. Selling and distribution expenses. Selling and distribution expenses. Now these expenses are directly related to the operations of the business, because if you will not incur the expenses on selling your product, right, then your sales might be low than expected. Right? Other one, employee benefit expenses. Employee benefit expenses. Now you have to keep your employees happy. If your employees are not happy, they will not work to their potential. As a result, what will happen? Who will suffer? You will suffer. As a businessman, you will suffer. So you have to make some expenditure on the employee benefits to keep your employees happy. Administrative expenses. Right? You have to hire some people, you have to pay salary to the administrative people who look after the various functions of the business. You hire some people who will look after the accounts, you will hire some people who will look after the inventory. All these things are directly related to the operations of the business. These things affect the operations of the business. If your employees are not happy, your operations will be affected. If your administrative department is not working efficiently, then also your operations of the business will be affected. Right? If you are not making appropriate expenditure on selling and distribution, advertisement, if you are not making expenditure on that, then also your sales may be lower than expected. Clear? So any expenditure which is directly related to the operations of the business, those are known as operating expenses. And what are the non-operating expenses? By now you must have understood what are the non-operating expenses. Expenses not directly related to the operations of the business. Right? So any expenses which are not directly related to the operations of the business, those are known as non-operating expenses. For example, interest paid, interest on loan. This is in no way directly related to the operations. No. Right? Dividends. All these things are not directly related to the operations of the business. These will not affect the operations of the business directly. So these are the non-operating expenses. Clear? So this is the basic difference between operating expenses and non-operating expenses. Now coming back to the operating ratio, if we talk about operating ratio, the name itself suggests that we have to consider only the operating expenses. Right? So under operating ratio, what we have to see is, so let us find out the various elements, the various factors, financial factors between which we are going to make the relationship under the operating. The first factor we have discussed is operating expenses. The second factor is cost of goods sold. That we have already discussed in detail what is this cost of goods sold. Right? And the third factor is how you will recover your operating expenses and cost of goods sold by selling your product. And if you are selling your product, what you will get? You will get revenue from operations. Right? So now there are three factors. If we talk about the operating ratio, there are three factors now. The first factor is operating expenses. The second factor is cost of goods sold. And the third is revenue from operations. Now, how this operating ratio helps? What does this ratio signify? This ratio signifies that how much of the cost of goods sold and the operating expenses are recovered from revenue from operations. Right? Now, what does this ratio tells? That if you are selling your product, you're getting the revenue. From that revenue, how much you are able to recover your operating expenses plus whatever the cost you have incurred in manufacturing or buying that product. So you have to cover two things from the revenue. The first thing, the cost of the goods sold. You have to recover the cost. Only then you will be earning the profit. What is the main aim of profitability ratios? That whether we are earning profits or not. So from the revenue, you have to recover the cost of the goods sold. Plus you have to recover the operating expenses. Then you have to see whether you have something in your hand or not. Clear? Then you have to see whether you have something in your hand or not. Let's take an example. You are a t-shirt manufacturer. Right? Now the cost of buying the t-shirt, cost of t-shirt for you is 1000 rupees. Your operating expenses are say 600 rupees. Right? Total cost is 1600. Now if you are selling this t-shirt for 1500 rupees, are you getting any profit? No, there is a loss. And if you are selling this t-shirt for 2500, then you are into 900 profit. Right? So out of 2500, we are able to recover 1000 cost of t-shirt and 600 the operating expenses. Right? After that, what is left is our profit. Clear, friends? So now how you build the relationship? If we talk about operating ratio, operating ratio is cost of goods sold plus operating expenses, right, divided by revenue from operations. That is how much of the cost plus the operating expenses, that is expenses directly related to the operations of the business. How much of these two factors are covered from the revenue from operations, right? Through this we see that whether our resources are being efficiently used and whether we are earning the sufficient revenue from operations to cover our cost or not, right? So that is the main aim of operating ratio. Clear? Now what is cost of goods sold? You all know. What is cost of goods sold? Opening stock plus purchases plus any direct expenses minus closing stock, right? This is COGS. Now what are operating expenses? I have given you some examples. See, the operating expenses can be office expenses. Then we have administrative expenses, right? Then we have selling and distribution expenses. Right? Selling and distribution expenses. Then employee benefit expenses to keep your employees happy. Then we have depreciation and amortization expenses. Depreciation is for the assets. Assets are directly related to the operations of the business. How? Because you are using those assets in manufacturing the product. So depreciation and amortization expenses. So these are broadly the operating expenses, right? So cost of goods sold plus the operating expenses divided by revenue from operations is our operating ratio. Now from all this discussion, just tell me one thing, just think about one thing. If you consider this ratio, higher the ratio the better it is, or lower the ratio the better it is. Just think about it. What should be higher? Your revenue should be high or your cost should be high? First answer this. Your revenue should be high or your cost should be high? If you think from a business point of view, what should be high? Your revenue from operations should be high or your cost should be high? Obviously your revenue from operations should be high. That means this denominator should be higher than the numerator. This should be lower. That means lower the ratio, the better it is. Lower the cost, lower the operating cost, lower the cost of goods sold, higher the revenue from operations, the better it is. So from this I can say lower the ratio, Lower the ratio, better it is. Clear? Lower the ratio, the better it is. Right? This is operating ratio where you have to establish a relationship between three financial factors, that is operating expenses. What are operating expenses? Any expenses which are directly in relation to the operations of the business. Then second thing, the cost of goods sold. And these two costs you have to recover from what? From the revenue from operations, that is from your sales. Clear? Clear, friends? So let's do one simple question on it. Say your cost of goods sold is rupees 6 lakhs. Your revenue from operations is rupees 8 lakhs. Your office expenses are rupees 10,000. Selling and distribution expenses. Selling and distribution expenses rupees 20,000. Employee benefit expenses of rupees 10,000. Now you have to calculate operating ratio. For the operating ratio, what do you need? The cost of goods sold. It is given as 6 lakhs. Second thing you need operating cost. Now operating cost is what? Office expenses of 10,000 plus selling and distribution expenses of 20,000 plus employee benefit expenses of 10,000. This comes to rupees 40,000. The third element you need is revenue from operations. This is also given. So now you can calculate operating ratio. Operating ratio is cost of goods sold plus operating cost divided by revenue from operations. Right? Cost of goods sold is 6 lakhs. Operating cost is 40,000 and revenue from operations is 8 lakhs. Multiplied by 100 because the profitability ratios are expressed in percentage. This comes to 80%. Right? So friends, this is how we are going to calculate operating ratio, building a relationship between three factors, the cost of goods sold and operating cost. And how to recover this cost? We are going to recover this cost through the revenue from operations. Clear? So this is all about operating ratio. And in the next lecture, we are going to start with the next ratio, that is operating profit ratio. Right? So friends, if you have any queries, just send me an email at ksjteaching@gmail.com. Right? So that's all for this lecture, friends. Thank you so much.